Welcome everyone, and thank you for bearing with us with our technical issues today. And thank you for joining us for our second money management session for 2021, entering the property market. So before we start, this is again another general information disclaimer that does not take into consideration your personal circumstances, financial situation, and needs. So here at O'Brien, we work with you to help create your ideal life. We do this by working with other specialists to ensure that the options and solutions provided to your clients are appropriate and suits your unique situation. So my name is Tracee Pang, and I'm a financial advisor here at O'Brien's. And I have Lisa here today as well to assist with any technical issues. So a property is a large asset, and it's extremely beneficial to have a great team to support you throughout this journey. So let me introduce you to our panelists today who are keen to help you in understanding this. So Rory here from On Home Loan, he's a mortgage broker. We have Zeno and Kobica from Viva Property, and also Rebecca Pugh from City Pacific Lawyers. So I'll just hand it off to Rory to start right now.
Thank you so much, Tracee. I really appreciate that. And thank you to everyone at O'Brien's for giving me the opportunity to present. So I will get my screen up. There we go. So yeah, look, once again, thanks to everyone for joining, and hopefully you get something out of it. I know that Rebecca and Zeno have got some great content to go through as well. So I hope that everyone was on the webinar last night, listening to Tracee. I know I was, with some great information. So I suppose what I'm going to do is take it from there, and we're going to say our client Jack, who saw Tracee, I'm going to say that conversation happened 5 years ago. So and now Jack's come to me, and he's in a little bit of a better position. The sums look like he'd have about $82,000. And I'm going to say he's got 100,000 just because it's easy, round number. He's come to us with $100,000, and now what can he do with that, and how can he enter the property market as a first home buyer with that? So a little bit about me and my business, Own Home Loans. We're basically all about helping people pay off their mortgage and get them into a better financial position, and that's why we sort of work really well with O'Brien's, because we've got very similar focus, and that's getting people into a better financial position. So an important thing that I want to look at before I go into the examples is just some home loan jargon. Every industry's got their jargon. We're no different in the home loan space. We've got our own jargon that we have, and it's just important to sort of know it before we go through some examples. So just quickly, your security, that's what we call a property. That's what we take security over a loan, but that's really the house. Deposit, that's just what you're going to put into it, so what your contribution is. And when we look at those two things, there's a calculation that is the next one, and that's the loan to value ratio. So what percentage of the property value are you going to borrow? Brings us to a loan to value ratio. Stamp duty, that's a government charge. State government charges, as governments love to do. They love to charge fees and taxes and charges. So on a property transfer, that is what that is. First home buyers, well, across the board, actually, there's some really good discounts in Victoria at the moment, across the board, but for first home buyers especially so. Under $600,000, there is no stamp duty payable. At $750,000, it's full stamp duty, and that's kind of a sliding scale between those two numbers. So, but yeah, some really great discounts around at the moment. FOG, which is first home owners grant. If someone's building a property, they may be eligible for a first home owners grant. Lender's mortgage insurance is a fee that you're basically paying the lender's insurance policy if you don't have a full 20% deposit, or for some lucky professions, a 10% deposit, but for the general population, a full 20% deposit plus cost. You'll pay what's called lender's mortgage insurance, which is a very expensive thing, and I'll show you in the examples what it actually means. and a guarantee. And that's the other way that we can get out of paying mortgage insurance. If you don't have a full 20% deposit, but you've got maybe a parent that's got some equity in their property, that's certainly a way that we can look at getting out of mortgage insurance. So it was just important just to touch on some of those things. It'll just help as we go through some examples. So this is a common sort of example of what we'd go through for a client. They come to us and they say, okay, I've got $600,000 right at the top there with a $100,000 deposit. What does that mean? What does that look like? And I'm a first home buyer. So first things first, there's very little government charges, no stamp duty, but there are some government charges. But you are not, it's not a full 20% deposit. So you're over 80% loan to value ratio. So there is some mortgage insurance payable. But really, really importantly, what I look at, and I encourage everyone to look at when they're looking at a first home, especially, is what the repayment is, obviously, and what's a comfortable repayment. So when we were looking at Jack's sums last night with Tracee, $2,241 per month was kind of where Tracee got to, which was a comfortable repayment figure. So what we want to do is keep the loan repayment, monthly repayment, under that figure. So in this example, perfect. We're under that 241. Which is great. So we can make the loan happen. If there was a guarantor involved, we would save that $4,243. What if Jack says, no, look, I don't want to pay mortgage insurance, don't have a guarantor, what can I buy? So then we reverse engineer it and we say, no mortgage insurance buys you a place for $493,100 as a first home buyer with a $100,000 deposit. Again, repayment, and I should say I've used 3% as an interest rate just to put a figure there. There's much cheaper rates at the moment, but it's a very, very low interest rate environment. So we just for example, we've used 3%. But the repayment is great, $1,663 per month, well under what Jack could afford. So that means we can actually pay down this loan much, much quicker, which is great. But if Jack says, no, look, I want to have a look at some examples of a higher purchase price, I'll just take you quickly through a couple. If we buy for $650, again, keeping a $100,000 deposit as stable, we're looking at 87% loan to value ratio. So therefore mortgage insurance is much higher. And now we're starting to sneak into having to pay stamp duty, because we're over that $600,000 threshold. We're not paying full stamp duty, but we're paying some. But importantly, our repayment down the bottom has tipped over that 2241. So now we're starting to get into a territory where potentially Jack might be just stretching outside of his affordability, and that's a real concern. And we just got to make sure that he's in a position to be able to do that. And then as we go up, I've only got a couple more examples. 700,000, obviously. The figures, repayment wise, mortgage insurance wise, stamp duty wise, all get much more expensive. So therefore the repayment is higher. And then the last one I've got, $750,000 purchase, because this is where kind of he's almost topping out. We really couldn't go much further with $100,000 deposit for him, because we're getting to a loan to value ratio of close to 95%. 95% is kind of, it's not technically the maximum. Some lenders will go past that, but the loans are horrible. They're really expensive, exorbitant interest rates, exorbitant mortgage insurance. It's, unless you really have to go there, we certainly try to avoid at all costs going over that 95%. Do it occasionally, but not very often at all. But most concerning in this example is just that repayment figure is just probably far too much for our friend Jack to be able to handle. So we'd really, we've pushed far too far. So as you can see, there's a few different calculations at play, and it's not linear. It's not, there's mortgage insurance especially is done on multiples. The higher loan to value ratio, not only the higher loan amount, but the higher the percentage that you're paying. So it's exponential. So it's certainly not a linear equation. So we certainly do a lot of these for our clients just to make sure they're across what the different calculations all mean. So that's a really important part of what we do. So what I wanted to do is just quickly just run through some pre-approval tips, just so if you're going out keen to buy, you get pre-approval. Pre-approval, it means the bank's checked off your credit. They've looked at your credit file. They've looked at your income. They've looked at your savings. They say, right, cool, we're good to go. We're happy to lend Jack out some money. So just some tips there. Not all pre-approvals are made equal. Sometimes they're just system generated. Sometimes the system will just go bang, yep, credit checks tick, as long as everything looks as the way we expect it when we go for the loan, we'll be okay. Now, that's not always the case. What we like to do for our clients is make sure that a person and a credit assessor actually picks up and assesses the file. So just know that not all pre-approvals are made equal. Certain banks just don't do them. So just be very careful with some pre-approvals. Check your statements first. Lenders don't like seeing things like, Betfair or big withdrawals at the casino and things like that. So we just got to look at spending habits, make sure we look at bank statements before they go to a lender to make sure that they look in a palatable format, and just discuss any spending issues that we might have. Be organised. Most people just haven't got all the information we need straight away. The more organised you are, if you've got your pay slips and whatnot there, group certificates from the ATO portal, or you've got your tax returns done if you're self-employed, the more organised you are, certainly the better for us. Don't lose your job. This is more, any change to your financial situation between getting pre-approved and actually buying a property is an issue. So losing a job is one, but there are others. Don't get extra debt and whatever. Just don't let your financial position get worse. Look at how many credit checks you do. They all, every time you do a credit check, your credit score goes down slightly. So we've just got to be careful not to do too many. We can do a credit check without it appearing on your file. So if you're curious to see what your credit file looks like, let me know and I can do that without it having an impact on your credit score. And as I said before, set a budget for your comfortable repayment. That is absolutely paramount. The last slide, just a few little things at the moment. Did you know banks are slow? The market is hot. I'm going into Zeno's territory a little bit. He'll cover it much more. Just that it's a crazy hot market. So if you're interested in getting into it, you need to get moving reasonably quickly, I'd imagine, because big reason is investors are back, not only first home buyers. Fixed rates are starting to move. So fixed rates have been historically crazy low, sub 2%. There's a little bit of a movement around at them. So if you've currently got a loan, we think about fixing, it's a good time for a conversation about those. Best interest duty is what I'm bound to legally. As a mortgage broker, I am bound to act in your best interest as a client, not in the bank's best interest. I just think that's an important recent change to what I do, which is a great thing. So people should be aware of that. I think I'm just over time, but thank you all for listening. I hope there was something in that for you, and love to handle any questions. I think at the end, once the other guys have had a chance to present, or send me an email and I'll answer any personal questions you have. But thank you so much. So I think.
Thanks, Rory. And now we have Zeno to speak next.
Awesome. Nice to meet you all here. My name is Zeno Kobica. I'm from Viva Property, and I'm a sales manager, and I sell property all over Melbourne. From CBD, small little studio apartments worth 100 grand a pop, all the way through to multi-million dollar homes in Kew, Coburg, up north, McLeod, through to the first home buyer belt in Tarneit, Point Cook, and then all the way back out to the southeast, Narrowwan, One Turner, and everything between. Gives me a great perspective on the market, unlike other real estate agents, which just concentrate on their own little patch. And I get asked a couple of questions in my travels a lot. If you can move to the next slide, Lisa. Questions are, how's the market and where's the best place to buy? Now, we could devote a full day seminar probably on each of these questions. We don't have that luxury today, but if I could answer these questions in probably 2 words, the 2 words would be it depends. If you can move to the next slide. Look, it depends on your unique circumstances, your income, deposit capacity, where you would like to live, what type of investments you have, what you would like, what sort of returns suit your circumstances. Do you need positive cash flow? Do you want capital growth? What's your risk profile, your timeline, exit strategy, so many more personal issues that are just unique to you. If I had an answer to address all these questions for you, we'd probably all be millionaires. Sadly, it's not quite as simple as that. Now, if you're a buyer out there at the moment, you may be experiencing some of the following. This is a 20-year-old home in Narre Warren. It's a family home, originally seeking 640, 650 grand, sold in 2 weeks, less than 2 weeks, for 740. 100 grand over the what it's really worth on paper. Next slide shows a home in Wanturna South. The last sale in this street sold for $1 million. Now we're breaking records at 1.5, also sold within a couple of weeks. So look, for an ideal home right now, like Rory suggested, the property market is going ballistic, especially in the first home buyer bracket of 600 to 700 grand, where all the government incentives are focused. So let's have a look at the actual trends. So the first graph at the top there is an interesting one. It shows the amount of property reports being created by real estate agents. So these are reports that agents create using CoreLogic data before listing a home. And typically, once the report is generated, the home gets listed within a few weeks or months thereafter. So it's like an early indicator report here that shows us what the trend is most likely going to be in the coming weeks and months. Now, if you look at the blue line in that top graph, the current 12 months, you can see in the last 3 months, Feb, March, April, the line is trending well above what it was on the grey line in the previous 12 months. So that shows the likelihood of more properties hitting the market is greater currently than the previous year, which is good for buyers who are missing out on properties. There's more properties to come. However, if we look at the actual advertised properties, which is the graph below, the orange is rentals and blue is sales. You can see for the past 12 months, it's been pretty flat. There's been no spikes in properties listed. In fact, there's a massive downturn in January. You can see there's a big dip below. So what this says is the amount of ideal homes hitting the market is likely not going to be enough for the amount of buyers wanting to buy ideal homes. And as Rory suggested as well, investors are back. So that's just going to compound the problem of buying your ideal home and potentially fueling further price growth. So what's an ideal home? Next graph, next slide. An ideal home is one in a family-friendly neighborhood. It's near shops, near schools, near transport links. It's not an off-the-plan apartment. That's a whole different kettle of fish, another seminar involved for that one. It's not on a main road. It's not a roundabout, intersection, near a cemetery, industrial zone, or backing onto a workshop. It's sitting at around or below the median price for that suburb. So it's like buying the worst house on the best street. You're buying a property in a great neighborhood below its average. It's going to increase in value as the other properties around it rise. It's going to be a great investment for you in the long run. And of course, the home has some sort of wow factor. So like, for example, the image there shows an amazing fretwork, fully restored, classic Victorian home. Has that wow, the jaw-dropping wow when you arrive. It's going to attract a lot of buyers, and it's going to potentially increase in value more than one that's not like that in future. So if you're a buyer, what do you do then? Well, I recommend getting everything ready to pounce. So working out your exact wants and needs. Get a financial advisor like Brian's here to map out a plan of action for you and to achieve your wants and needs across an ideal time frame. You know, right now might not be ideal time frame for you, maybe in a few months or a year or years down the track. When you're ready, then do your research. You know, if you have to engage a buyer's advocate or do your research yourself, get onto the portals, realestate.com, domain.com, go to auctions, go to private sales, see what your ideal home is actually doing in the market and how much it's really worth and what the capacity for its property potential price growth is going to be. Now, the next one is getting your finances ready. Now, I can't stress this one enough in the current environment we're in. Speak to Rory here, a mortgage broker. Get your finances ready so that if you do find your ideal home, you're ready to pounce. You know, you're not going to be in a situation where you have to wait 3, 4, 5 weeks for your home loan to be approved. By that time, the vendor is going to find another buyer and you're going to miss out. So get onto that as soon as possible. Also, get onto a lawyer. Get onto City Pacific lawyers here, Rebecca and Elizabeth there, to be able to review contracts for you quickly. Again, so get your paperwork sorted, get it ready so that you can pounce before other buyers do and don't miss out on your ideal home. And also, look beyond the pretty Caesar stone benchtops and wonderfully staged furniture, which is all the rage now. Click on the next slide. This is a beautiful bedroom in a nicely presented, clean, neat, tidy, great place to sleep. In reality, though, it actually looks like this. This is exactly the same room, just not tidied up, just not presented to sell. And this, by the way, is what I'm presented with every day as a real estate agent when I come visit a home. It's my job to make a space look amazing, incredible, to get buyers like you interested, get more buyers interested and pay more than what they should for a home. Look at next slide. The gorgeous kitchen, you know, it looks like it's got a lot of space around it, but in reality, actually it looks like this. It's a little bit different, you'd have to say. But conversely, if you're presented with this one the first time you come visit a home, and don't immediately discount it, because moving all the clutter aside, there could be a gem of a home underneath all that that could actually suit you. So look at both sides of the coin when you're out hunting for a property. One more example, next slide here, beautiful outdoor, huge pool and entertainment area to enjoy. But in reality, it actually looks like this, a tiny small plunge pool, concrete jungle. These are all tricks of the trade to look out for when you're out house hunting. Now remember from our previous seminar, if you click on next slide, it's actually, right now, it's cheaper to buy than rent in over 50% of Australian suburbs, and that trend has actually increased. So if you have all your ducks in a row, you've got everything ready, now is actually a great time to be out there buying your ideal home. So good luck in your property search. I'm going to be signing off right now, but if you have any questions in this space, let me know. My name is Zeno Kobica from Viva Property, and I'll be honored to help you.
Thanks, Zeno. So next we have, oh, by the way, I love the slides. Next we have Rebecca.
Hi everyone. I seem to have some trouble starting my video because it was switched off. Here we go. There we go. Here I am. I'm just going to share my screen with you as well. And so hopefully you can all see that screen. I might just ask Zeno or Rory or Tracee just to give me a thumbs up if they can see it.
We can see it. Thanks.
Oh, awesome.
Yep, all good.
Okay, so thanks to Rory and Zeno. My job has been made much easier to go through some of the legal aspects. So You've been to see Tracee 5 years ago, talked about your how to build up your cash base. You've then gone to see Rory, and then you're looking on the market, and I'm just going to touch on a few of the things from a legal perspective that you need to be looking at when you're looking to buy your first home. So I'm just trying to get to the next slide. Obviously, all of this is very general. So the key players in purchasing a property are your vendor, your purchaser, you guys, and then the others listed there up there on the screen. And when you're purchasing, it's good to remember, and Zeno's just touched on it, that there are really only 3 key players when you're buying a property who are involved in the process. So that's yourself, that's your lawyer, so maybe like someone like myself, and then someone like Rory, your broker or your lender. The person that it was on the previous slide that is not on this slide is the agent. And it's just good to have in the back of your mind when you're going through properties, having a think about that, because the agent is obviously someone who's been engaged by the vendor. And as Zeno said, they've been engaged, you've seen all the pictures, they make everything look pretty, and also, you know, they're acting to get the best price for the vendor. So it's just something to keep in mind when you're looking at properties. So I've also followed on from Tracee's real life example, and I've got Jack and I've also got a Jill there falling down the hill. I put up some categories about what next for Jack and Jill with those kind of, it's their first home, they don't have pre-approval, looking at new and existing houses, what do they do next to stop them falling down any potential hills. The fundamental step, and I think we're all beating the same drum here, Zeno, Rory and myself, is that the next fundamental step when you're looking to purchase a property is getting advice. So seeing your broker, maybe first of all, what's your lending capacity? What are my repayments going to look like? Asking Rory these details, someone like Rory these details before you make the next step and go looking around properties. Then when you are going looking around properties, the vendor and the agent's going to have all of their contracts and sale documentation out on the side. Grab one of those, ask them to send you a copy and flick them to someone like myself so that we can have a look and get you through your legal due diligence. And I put in an optional for an accountant, but that as a first time owner, you may not need to if you're not buying in a particular trust structure like a family trust or a self-managed super fund. So when I say due diligence, what do I mean? Legal due diligence. I'm talking about reviewing the contract of sale and vendor statements. So we get a lot of inquiries and we're more than happy to assist first homeowners and walk you through this process, because as a first homeowner, if you're not in the industry as well, these things can be daunting to look at. The vendor statement is something that all vendors are required to do under legislation, the Sale of Land Act. And essentially that discloses to you as a purchaser what's going on with the property, what are the rates associated with the property, what are the boundaries of the property. And so when you're doing your due diligence, there are several ways you can do it. One way of doing due diligence is when you're at the inspection and you can look around. But in saying that, not everything is visible. So and I've had a couple of matters, for example, this week where people have come back to me, they bought last year, and now they're saying, we bought, we've settled, but now we're seeing issues with our foundations. We're seeing issues with water leaks. And one of the first things I say is, did you get advice or did you get any inspections, like building inspections, before you entered into the contract? Because the key thing here is that in Victoria, purchasers are still required to make their own inquiries before entering into a contract and signing on that dotted line. So if you sign away on a contract and you haven't gone to a lawyer and had things looked at, you might not have had a builder look around the property. You could be one of my clients who's coming to me now saying, Rebecca, please help me. I need to spend 50 to 100K to fix the foundations of my property. And had they known about that beforehand, by getting a build inspection or by getting a lawyer to review the contract and say this could potentially be an issue based on a building and certificate we've seen, that may have affected the offer they put in. So that's, I cannot stress it enough. This slide is really on the same vein. Avoid the pitfalls. What kind of things are included in the sale? You may go into the property and, for example, you know, there's a beautiful chandelier in the property. Is that included in the sale? Check the contract, get someone to check the contract for you. Chandelier, light fittings sometimes are included, sometimes they're not. Sometimes vendors take things and sometimes they're excluded. You need to get those things checked. I've already spoken a bit about building, but another big one that I've had two of again recently are boundaries. Just because the fences are where they are on the property doesn't mean that's where your property title boundaries actually are. And it's important to get that checked. It's a very expensive exercise if you need to have an adverse possession claim made after you've settled and you're not sure where your boundaries lie. Easements, covenants, all these restrictions. If you're buying your first property and you want to extend out the back, is there a water drainage easement? Do I need to get consent to build over it? Has the vendor already built over a drainage easement? And just one more thing on this slide, the buying at auction, it's key to know that you have no cooling off rights. And that means you're going into an unconditional locked-in contract when you sign the contract of sale at auction. So you cannot have any special conditions added in. It is what it is. You can't get a building inspection. So it's important then to do your due diligence beforehand. I have put owners corporations down there at the bottom, and my only thing there is owners corporations certificates on the back of contracts can be difficult to navigate, and that's why I would get a lawyer involved. How many levies are there on the property, and things like that? Are there any coming up? Flammable cladding is a huge hot topic in the legal industry at the moment. It's still going on. The government's still taking a while to fix things. And you as an owner will be liable for any cladding rectification costs and whether it affects your apartment or not, if there is cladding on the property. So another thing to take into account, and Rory did touch on this, is taxes. Rory spoke about stamp duty. Obviously under 600,000, you're getting no stamp duty. And then it's on a sliding scale upwards from there. There is a difference as well between a first home owner concession to duty and also the first home owner's grant. The government has also in a stimulus package recently for certain contracts signed in a specific time frame offered waivers of stamp duty, depending on whether you're buying an existing home or vacant land. You can get further discounts if you're buying over a certain amount for your stamp duty. So if you are looking at the moment, that's something to take into account and something you can really benefit from in this hot market, as Zeno was saying. Just a note that GST can come into play, especially if you're buying a new property or off the plan. As Zeno said, off the plans are a completely different kettle of fish. They are a whole other seminar in themselves, and even more so with off the plans, you need to get your contract reviewed. Those things can go from 200, 300, 400 pages. There are masses of conditions in there that protect developers and sometimes can leave you a bit short when you come up to settlement. The only other thing is if you're buying your first home, you're not going to have any land tax if you're living in the property, and we call that your principal place of residence. If you then move out and later and you talk to Tracee and you've said, oh, look, I can now use this as my investment property, you would then get charged land tax on that property if you're no longer in it as your principal place of residence. I'm going to shoot through the last few slides. I'm just mindful of time. There's a couple of different ways you can hold property, and it's something to think about before you sign a contract or when you're having discussions with your lawyer about whether you want to hold the property. If Jack and Jill, for example, wanted to hold the property together as joint proprietors, that means that if one of them were to pass away and kick the bucket, so to speak, then the other one would inherit the whole property without needing it to go through a will or an estate process. However, if you hold the property as tenants in common, and some first-time owners do this with their parents sometimes, that means that if one of the parties passes away, then the property gets dealt with in accordance with the terms of the will, and it doesn't automatically go to the other owner. So it's just something to be mindful of when you're having discussions around this with your lawyer. And finally, the process of conveyancing has become a lot easier or simpler from a purchaser perspective since e-conveyancing came in. Gone are the days where you're needing to attend an office like mine here, and you're needing to sign transfers of land, different stat decks, all these other things. Essentially now, all we need you to do from a legal perspective is do a verification of identity so we know you are who you say you are, and you authorize us to prepare and sign off on the documents on your behalf. Obviously, we send you drafts and things like that beforehand. But the whole process is now done seamlessly through an electronic platform, and your bank would join that platform, the vendors would join that platform, the vendors' bank would join that platform, and it means that there's a very seamless integration. So the vendors get paid pretty much on the day of settlement, and your name, importantly, gets put on the title on the day of settlement. And it doesn't take sometimes the couple of months that it used to with the banks having to queue up at the land titles office and put stacks and stacks of titles and piles and transfers to be made. And just on that as well, your title, you won't ever have a physical title, especially now with COVID. The land titles office has actually stopped issuing paper titles entirely. I am not sure if this will be reinstated. That's yet to be seen, so watch this space. And whoever holds your title, generally your lender, will have control of that title until you discharge your mortgage with them or refinance or you sell. And that brings me pretty much to the end. I know we've got to make some time for some questions, but if any of you do have any questions about a specific property you're looking at, or you've got any questions of anything that I've raised in my slides, I'm always happy to have a chat. I don't think I gave a bit of a background about myself, but I've been in the property law area for about 7 to 8 years. I work with Elizabeth. I think Rory and Zeno might have mentioned her, and she's an accredited specialist in property law. So between the two of us, we've seen a lot. We still see a lot, and we're happy to always take the calls and just give some guidance when you're looking at first property.
Thanks, Rebecca. There was a lot of very good information that everyone needs to know. So now we're going to do our question and answer time. If I could have the panelists back on. So I have a question here for Rory as well. So it's quite common for some parents to recommend their kids to apply for a credit card to try and get a credit history before they get a loan.
Sure.
So just wondering what your thoughts are on that.
Oh, look, I don't think it's necessary, Tracee. I think that credit cards can be very, very dangerous things in the wrong hands, I suppose, and if you don't really need them. I've never had a loan declined because the person didn't have a credit card. It's never happened before in my experience. So I think most people open a credit file when they maybe have a phone account or something like that, or a services that is connected to a property. I've never seen it needed that a credit card was required. I think credit cards are evil and should only be used, once people are used to using other forms of credit and banking.
Great. Thanks for that.
Pleasure.
Lisa, do we have any other questions as well?
Nothing in the chat box at the moment. If anyone has any questions, please feel free to add them into the Q&A and I'll ask our panelists on your behalf.
I've got a question for Rory as well.
Sure, mate.
Rory, you mentioned about statements being checked and maybe there's ways that you can help rectify that, or is it what the what you know? What if you're buying like coffee every day and that sort of stuff? Does that really get nitpicked?
It doesn't to that level. It's more just they want to see trends, and there's a big difference. Between certain types of expenditure, there's certain things that discretionary and you can stop. There's certain things that you can't. So they're looking for the non-discretionary stuff, number one, and then they're looking for habits. And the only ones that really get pulled up, it's got better recently. It was horrible for a while, and they were, nitpicking. Oh, you see all these pet barn transactions. How many dogs did the client have? It's just like, wow, that was just crazy level. Now, it's got better, but they're just looking for patterns of not the best credit behavior, and they're looking for undisclosed debts. So, if you've got a payment going off to a credit card, they'll say, well, why didn't you tell us about this credit card? So there's, that's why it's good just to have a look through them, make sure that what we're presenting to the bank is the right information.
Cool. Awesome. Thanks.
Nice.
So just wondering, if you had like 5 subscriptions to like Netflix, Disney Plus and all that, do you need to cancel a few?
Only if you can't afford them, Tracee. Once you get your home loan, you keep all your subscriptions going for now, and we'll talk about them later.
We're in a subscription era at the moment. Everyone seems to sign up for many subscriptions.
Absolutely, just to get that one show that they wanted, and then they watch that show, and then that subscription goes forever and a day. So yeah, absolutely.
Yeah. Well, I'd like to thank you again to our fantastic panelists for your time today. And thank you to our audience as well who have signed up for our webinar. So everyone enjoy a long weekend, and thanks for your time.
Thank you.
Pleasure. Thank you.
Thanks. Bye.